Hi and welcome to everyone in this generator event. Welcome to today's session, Getting Investor Ready. So I'm Lloyd Gordon, Communications and Marketing Manager at the Generator. So we'll give everyone a few minutes just to join us, but we'll get started very shortly. So before we start, I do want to just call out that we will be recording. We'll make this available to attendees and our community following the event. So thank you everyone for taking the time and joining us today. I wish to acknowledge the people of the Kulin Nations on whose land we are gathered today, and from where you are joining us today. I pay my respects to their elders past, present and emerging. So today we're talking about getting investor ready, a step that every startup, or 99% of startups, will need to take at some point to enable growth. Before I introduce our guests, a little bit of housekeeping. We'll use Slido to facilitate some Q&A today. I'll drop that link into the chat today. So please refrain from using the chat, and if you have questions, direct them to that Slido link. Also, just some more housekeeping. Please remain on mute unless you're part of the conversation. Be respectful, mindful of others, and be present. Participate and own this moment with us. So joining us today are Ludweenah Graham and Hugh Stevens from Galileo. So Luddy is head of platform and community, relatively new to the team, but with a wealth of experience in the Australian startup ecosystem. And Hugh co-founded Galileo. He's no stranger to Monash, having studied here, but the relationship goes far beyond that. So I'll let both of you introduce and kick off, and thank you both for joining us, and we're lucky to have the time with you today, so thank you.
Thanks, Lloyd. Hi everyone. Welcome to this session on getting investor ready, focus on seed fundraising. What I might do is share my screen and then do a quick intro on Galileo and then on Hugh and I. Just 1 second. Awesome. So can you see my screen?
Yep.
Lloyd? Awesome.
Yes.
Wonderful. Okay, so who are we at Galileo? We're a new model of VC for the new generation of founders. So here at Galileo, we think the current VC model is broken at seed stage. And so we're doing things differently. How? By offering global founders funding and post-investment platform support and guiding and coaching throughout the 12 months. So one of the reasons we believe the model is broken is due to the lack of education and transparency between investors and founders, which brings us to the topic today on getting investor ready. So just a bit of background about us. So I'm Luddy, the head of platform here. So my background is working with some of Australia's most pivotal startups. So I've gone from startup operator to VC. And then I guess like my perspective on a VC lens is through helping founders get to that 0 to 1 phase and truly understanding how hard it is in that time when you're fundraising. I might get Hugh to do your perspective and a bit about your background too.
Sure. So hi everyone. Thank you, Lloyd, for inviting us to come and speak to your teams here. So I'm Hugh. I co-founded Galileo with James Alexander. He's my co-founder in the fund. And before that, I ran a startup, or I still do run a startup, kind of on the side. It's a bit of a long story. I worked in a few startups. I worked in government. I worked kind of notionally with one of the venture funds in Australia. Did some angel investing, sort of off the balance sheet of the business, and yeah, sort of have a fairly broad background. My initial career was in consulting, having studied at Monash originally, and so I think really, as Luddy said, the reason that we really built Galileo and the reason that we actually decided we'd start Galileo was really around this question of, from my experience and from James's experience of, the existing funds within the ecosystem. A lot of the time, when it came to first-time founders, and I was, everyone's a first-time founder once, but when it came to first-time founders, we found that often those existing participants and those existing funds discounted that type of founder compared to someone who was, on their third or fourth startup or something like that. And so we went to market and, we went to raise money from investors and everything else, sort of with this explicit intent to say, let's actually build a fund, but also kind of the operating system and the support that's necessary to really help first-time founders, grow that big, substantial business. So it's been a really interesting journey. We've been investing for the last 12 months, and we were fundraising for a couple of years before that. So it takes a very long time to raise a fund, let me tell you now. So really, really excited to talk and sort of give a bit of my perspective on that.
Great. So just a disclaimer, this particular session is not a step-by-step guide on how to raise a seed round. There's a lot of resources out there for that. What we realized after many deck reviews and conversations is there are a lot of founders missing key points when they pitch to us. And I think this is just also to every other early stage VC as well. So this particular session is about putting your investor hat on and looking at your company from a VC's perspective. So founders, have you truly asked yourself whether your business is truly venture backable? So this session is designed to help you understand that a bit more. So in this session, what we'll do is we'll cover a few themes throughout the Q&A. So that's team desirability, venture scalability, market and vision, traction, go-to-market strategy, and valuations. So I put that one in bold because I think that one's a bit of a Pandora's box for us. Awesome. So while we're here, I might actually just, so we're all on the same page, highlight what seed funding is. So simply put, it's funding that helps you bring your product to market, sign your first customers, and advertise to public. So key indicators on this is, to identify this, is a solid founding team, an MVP product ready to launch, and market interest. Hugh, do you have anything else to add on this while we're here?
I think the thing, I guess, that I'd say that really, again, was kind of part of the thesis and really why we started Galileo was one of the things that I would say has changed in the last 10 years is that you no longer, typically speaking, there are of course exceptions, but typically speaking, 9 times out of 10, you no longer need a substantive amount of capital to actually launch that first product, and launch that kind of MVP or get to the point of where you kind of have the first customers on some sort of beta or early version of it, and whether that's something where you've kind of been able to cobble it together with various bits and pieces or whatever it might be. Back in the day, say 10 years ago, you would need to spend 6 or 12 months doing that, whereas now thanks to the sort of the number of bits and pieces you can stick together and sort of the advancements in technology and everything else, you can get a lot further along. And so we commonly will see people where we're writing the first check for about $250,000, who've never really raised money before. Maybe they've gone through a program like the Generator where there's a bit of grant money that's come in, but they're already at the point of where they're successfully generating either generating a little bit of revenue from customers or certainly have people using the product. So I think there's this sort of old myth that you needed to have a whole lot of capital to get to launch. But actually, most of the very, very successful products in almost all industries have had this piece of where the early product is very, very narrow, and have been able to sort of launch with this very slim product, knowing it's going to get bigger over time. But that helps us as investors get an idea of really what does the business look like and how do the founders think about executing, and how do you execute to be able to kind of get our confidence up in terms of investment.
Great. So as we run through the questions, we've got Slido. Lloyd, do you want to pop that link in the chat for everyone else? If you have any questions, pop it through Slido. And then
someone asked what a VC is. A venture capitalist. Sorry. It's a good question. I forget.
That is a good question.
University audience, VCs are vice chancellors. No, VC is venture capitalist. So venture capital funds are run by venture capitalists. Good question, though. Something that we should.
That is a good question. Great. So why don't we get started? Today, he's going to be our VC sorting hat as we run through the questions. I'm going to stop the slide now, and then we'll get started.
Really a worrisome image, let alone that I clearly need to update my headshot, but anyway.
Yeah. All right, first question. To fundraise or not to fundraise? When is a good time to start?
Yeah, so I think with a lot of the answers, I guess, that I'll give is that there's never really a perfect time. I think there sort of is two ways. One way of thinking about it is you fundraise when you have the opportunity to. So, when they're, and I think, for example, of things like, food ordering systems for restaurants and cafes, right? That whole industry is going wild at the moment. So if you're in that industry, now's a great time to fundraise because everyone's going, oh, wow, the industry is going wild. So sometimes there's a macro sort of theme that can come on top of that sort of is encouraging you to do that. But realistically, for most founders in terms of practical reality early on, is you fundraise when you need money for the business. And the right timing for that really depends on who you're actually fundraising from. So for us, for example, and Luddy's already mentioned sort of effectively the core criteria that we look at in the companies that we invest in. But for us, it's like we want to see that you have that degree of early customer insight. So I'm very big on this idea of customer insight. And so with the founders that we invest in, we need to really understand this piece of, hey, like, who exactly are the early customers for this? And what are they saying? Like, why is this different? Oh, sorry, it's a garbage truck going past outside. Why is this different for them than what they're doing now? And what's that pain point that you're solving for the customer? Because that's something that's actually, you don't even need a product to get that insight, to be clear. But with a product, what you'll discover is as soon as you show an MVP and you get a customer to start using an MVP, suddenly you'll get all of this feedback that you'll otherwise have no idea about. And even people that have deep industry knowledge and experience and things like that, as soon as the product hits a customer, everything kind of changes. And so really for us, the right time is to say, hey, you need to have a reason to spend money, right? So, there's no point coming out at seed and saying, hey, I want to go and raise a $50 million round when you have 0 employees. But more importantly, it's like, what actually do you know, and what is it that you know, and how have you actually proven or how have you demonstrated some of those questions? Every business has these things at its core where they're unknowns, right? And maybe that's, for example, will people pay for this? Or maybe it's, do accountants care enough to move from system A to system B, or whatever it might be? And so whatever those really core questions are, a big part of your job as a founder is to always make sure that you're trying to do things, whether that's launch products, get customer insight, whatever it might be. You're trying to do things to actually help get answers to those questions. You'll never get purely accurate answers. But what we want to know as investors is we want to know, hey, what are those questions? What do you think of those questions? We might have different views on what those questions look like, but how are you trying to answer them? And so we want the right time to raise is when you're sort of in the process of, and you sort of started to answer those questions, because that's what we're going to want to be able to understand. When it's just still at that point of like, oh, I've got this idea and I'd really like to do it, you're going to have a really, really hard time raising any money. Whereas once you start doing that piece of, oh, we've cobbled this together and I've spoken to XYZ and XYZ said this and ABC said that, that's the point where it's really useful to start having those investor conversations, because that sort of is the expectation that we'll have in terms of you having done the work before you talk to us and before we write you a check, really.
What are other bad reasons to raise, Hugh?
A lot of a very bad reason to raise is because you think it will validate the business. And I think there's a really unfortunate belief in the industry sometimes where, that like every business needs to raise venture capital money, which is wrong. I didn't raise VC money for my software company. So I run a totally bootstrapped software company. And I think a bad reason to raise would be, just purely for the sake of, hey, I want to have the validation of that. Other bad reasons are someone else said that I could raise, or I think that I think that we need to spend 50 million on something without really having a good reason, or it looks like a good number. I literally have had a founder say to me before, not as a VC, but a friend of mine as a founder, and I said, oh, like that's a, you know, like, why are you raising that much? And he said, oh, it just seemed like a good number. And you're like, so, you know, you really want to have an idea of actually what you're using the money for, because we're going to ask you, hey, what is the money going to be used for? And when you say, oh yeah, $1 million just felt like a good round number at the time, it's not
quite
really
valid.
It doesn't deliver a lot of confidence that, you know, you've got a plan that you're going to execute on, you know, when you actually have the funding in the bank account.
And timing wise, how long do you think it typically takes? I see founders underestimate this time quite a bit.
Yeah, so I mean, you hear a lot about the rounds that close in 10 days, and we've had rounds that, you know, start to finish will close in 10 days. But typically speaking, those rounds are the rounds where we've already known the founders for months and months, you know, and we've kind of been either talking on and off. I mean, we've been on update lists or whatever it is for, you know, some period, or we, you know, and that may stretch up to a year, right? And so, you know, while yes, you can have rounds that come together very, very quickly or things like that, and sometimes that's for a reason where, again, there's some sort of exogenous or macro theme that's happening of where, hey, you know, this thing's happened and therefore we need to have some more money right away. But generally speaking, you know, the rule of thumb, I guess, is it takes 3 months. And you've got to kind of assume that you'll be nearly full-time on fundraising for at least 2 of those months. Because it does take time, it takes effort, and it takes, you know, you've got to kiss a lot of frogs to find your prince. And that's a good thing. That's actually, you know, it kind of should be that way. Because investors ultimately have their own thing. You know, we've got to deliver returns for our investors, or if it's an angel, then they've got to think about, you know, whether that's the right place to put their money compared to, you know, buying Dogecoin. And you know, you've got to be able to actually, you know, find enough people that believe in your mission and you, and that does take time.
Speaking of kissing frogs, how targeted should founders be?
Yeah, I don't have a good answer to this. Like, I think the key thing for us, or for me, would be to say that what you want is you want to have a mix. You want to either have the right kind of aligned investors, and by aligned investors, I mean that, for example, as an institutional fund. So, you know, we're a fund we're regulated by ASIC and all sorts of stuff. But like, the reason our investors have given us money is because they want a portfolio approach, right? So they want to have, you know, 30 odd companies in their portfolio at the stage that we're investing in. And as a result, when 20 of those portfolio companies die, they're going to go, oh, cool. If none of them die, they'll actually be worried. You know, they'll say to us, hey, Hugh and James, you know, have you taken enough risk here? And that's very different to, you know, sometimes, and certainly I've seen situations where, you know, someone goes through a messy divorce and then they say, hey, I want my money back. And obviously you can't really sell shares in a startup. And you can have these very, very messy scenarios in situations where people don't understand, I guess, the nature of investing in sort of early stage companies, and the liquidity profile of early stage companies, which is essentially zero liquidity, right up until the very, very, very end. And so as a result, I think, you know, my first thing to say would be find the investors you think are the ideal investors, and then obviously engage with them, whether that's because they have an understanding of the industry you're in, whether that's because, you know, you think they're particularly great, whether that's that, you know, they're particularly well, you know, suited to you, whatever it is. But kind of work your way down. Don't just sort of like start with the people that are most convenient or something, because that alignment becomes really important both early on, but also as you grow. Because again, you know, like I've seen situations as an angel where you have random angels with 1% of the company trying to demand to get onto boards and things like that, and you just go like, go away.
We've got a good question here from Alex Taylor. Thoughts on moving over to overseas markets to get seed funding instead of Australian VCs?
Yeah, look, one part of the answer to this is really like, where do you want to live? The nature of the world now, particularly post-coronavirus, but even coming into coronavirus, is that the US investors no longer require people to live in America to invest in them. Back in the day, it would be like, unless you were a Canva or something like that, you know, where you're like, okay, cool, you know, they'll write a check anywhere for Canva. But back in the day, it was like, unless you were that sort of like red hot, incredibly sexy deal, you know, you'd have to, you know, re-domicile the entity into Delaware or, you know, whatever it is. And I think that's no longer the case at all. We definitely see the US investors happily investing in Australian companies, both at a more typically at like a Series A and beyond stage, but even earlier than that at times. The benefit you have of US investors is the market there is more frothy. That means that there is more capital washing around and things like that. The downside of that is that valuations, and I think we're going to talk about valuations later on, but there's a delicate balance between what you want in valuation, and having to hire valuation early actually risks you as a founder getting much more wiped out than sort of having a lower valuation and laddering your way up over time. So if you want to go and live in San Francisco and you want to go and live in the US and all that sort of stuff, then great, absolutely move to the US, and raise from US investors. But you've got to work with these people for 10 years for one thing, and so you want them to be well aligned with you, but also there are sort of those dynamics of the markets that there are I guess differences. And one of the reasons that we see the US investors looking into Australia very heavily is because for them, Australia is a cheap valuation market compared to San Francisco or something like that. But over time, those things start to average out.
Yeah. All right. So one of the most common questions we ask ourselves when we're reviewing startups and decks is whether a startup is venture scalable or just a small to medium sized business. Hugh, what would you say are good characteristics of a venture scalable business, and what makes it a small to medium sized business?
Yeah, so I think VCs often come across as massive dickheads when they talk about this point. I'm allowed to use the word dickhead. And I think part of that is because, there's this thing of like, you don't run a successful business unless it's venture scale and, it produces billions and billions of dollars and all sorts of stuff. And that's an absolute lie. Like some of the most cashed up people I know as founders run small businesses, whether it's like concrete manufacturing or plumbing, regular small to medium businesses can still get really big, hundreds of employees, thousands, like Visi, the cardboard manufacturer, is was a small business that became a very, very, very big business. The big difference between really a venture scale business and a small to medium business is there's sort of two things. One thing is that venture scale businesses are designed such that they become very valuable very quickly. And to become very valuable very quickly, Visi became valuable over a couple of generations of the family, right? But by comparison, a venture scalable business will typically become very valuable over 10 to 15 years. And that's obviously a much, much shorter time horizon. But to get there, you've got to take a lot more risk. So, starting a new cardboard manufacturing company is in many ways lower risk in the sense of risk return profile than running a big mega scale software company. So there sort of is this risk reward piece of it. And then secondly is sort of like the way that they grow. So generally speaking, like an SME will grow at a fairly linear rate, right? So linear may still be 10, 20, 30% year on year. So it's good. And business growing at 30% year on year still feels like a really fast growing business. And that's, that's a very good SME. And that will still grow very big quite quickly, but it won't grow giant very quickly. So what you typically see in venture scale businesses is that instead of growing 10, 20, 30% year on year, they're growing 300, 400. And you look at, for example, the Canvas or people like that, and you can just look at headcount purely, year one is, they've got 4 people, then suddenly they've got 30, then they've suddenly got 120, then suddenly they've got 300, then suddenly they've got like 1,000, and just like the headcount scales really quickly year on year that you don't really see very often. And generally headcount is a sort of, roughly proportional sort of measure to the core metrics of the company. So that's why VCs talk about headcount. And so we sort of, so you see revenue grow the same way, right? So if it's a B2B software company, it might triple revenue every year rather than just going up 50%. And that gets very, very hard to do at, year 8, because, year 1 to year 2, where in the first year you might do 300 grand in revenue, and then year 2 you do $1 million. That's still, tripling roughly your revenue. Suddenly in, year 5 or year 6, you've got to go from 15 million to 60, and you go, oh, that's tricky.
That's a good answer. And then onto team desirability. So for this one, in my view, like a team that you build is just as important as your business, if not probably more in this stage. For you here, why is a starting team so important to investors?
So really, I mean, at the stage that we invest, the team is all we can really measure the business on. You know, we don't have, you know, again, unlike a bank looking at a loan for a widget manufacturing company, we don't have 10 years of operating background to be able to go, oh yes, you know, customers typically spend this much in the business, and if we put a new widget machine in, then maybe there'll be a 30% reduction. You know, like we don't have anything like that we look at. So really for us, a key part of that is absolutely the team, because it's really all you can measure it on, right? You've got some early indications from customers, you know, lots of stuff, but really the customers are an indication of whether or not the team can hustle and whether the team can execute and what that looks like. And then in startups, the reality is for the first 3 or 4 years, if not longer, you are the team as the founders. You know, and yes, you'll have employees and things like that, but like you'll readily find that suddenly you've got to do the 2 a.m. wake up to talk to the, you know, European prospects because it happens to be that the only time they're available is 2 a.m. on Friday night. And you'll go, okay, cool, I'll wake up at 2 a.m. for that call. And that's really, really hard to ask an employee to do. But you need to actually have founders where, and that's a good situation, right? It's like a customer sales call. Bad situation is like, hey, like things go wrong in startups all the time. And as a result, as a team, you need to be able to actually survive through that process, almost is what I'd call it. You know, as a founder, I've been through the way too many near-death experiences. It's not funny. And it's some of the worst experiences of your life when it happens. But you've got to, as a VC, you've got to make sure that when those situations do occur, the founder is going to be able to actually navigate that because it is really hard. And that's why, you know, the founding team is so important, because in those early days, the earlier and earlier the business is, the more everything rests on that founding team to be able to actually really just sort of grind through those challenges in a way that just isn't really the case as it gets older, but it still is somewhat the case even at, you know, substantive size.
What do you think the importance of accountability and coachability is of founders when dealing with them?
Yeah, so there's a balance of this, right? Is that to some degree as a founder, the reason that you're starting a business is because you believe something other people don't believe. And so there is some degree of where like you're going to have to be at least a little bit contrarian, because that's why you're starting this business. You know, like if it was something that was like a clear, you know, absolute home run kind of company, then I'd be very worried. So you have to believe something that isn't that isn't common or isn't obvious. What happens at the same time is like you shouldn't be reinventing the wheel where you don't need to. And we see sometimes these sort of founders who, you know, you'll talk to them about something and say, that's interesting. Like this is kind of the way this is normally approached. Like, why is it you're not approaching it that way? And they'll sort of go, oh, I don't want to do it that way because that's the way that everyone else does it. And you're like, well, but maybe that's for a good reason. So unless you have don't just do it a different way for the sake of doing it a different way. Like do it a different way because you know that existing way won't work, or, you know, according to your customers, that way doesn't align, you know, that pricing model doesn't align with how they want to buy software or whatever it might be, rather than just kind of reinventing the wheel from scratch. And so that's where I think that coachability comes in, because one of the benefits that we have is, you know, as a VC, we sit across a lot of investments, but also, you know, we have investors and mentors and things like that have a background across tons and tons of companies over a lot of time. And you do pick up things where you can sort of see a little bit around the corner. And sometimes, you know, even Luddy, I think, has probably seen some of the meetings with me where I'll sort of gently prompt things because I know the drama that is coming around the corner if you make that choice. And we won't say, don't make that choice. You know, it's not our job to run a business on behalf of a founder, you know, it's your company. But we will absolutely say, hey, like, have you thought about this thing? I've seen this thing go wrong in this way in the past. You might want to think about how you might mitigate that challenge.
There's usually a few nudges with that, to which my response is, some founders just like to learn the hard way, and that's just how you learn and grow, essentially.
And you do, like you absolutely do learn the hard way, and you make wrong decisions, and that's part of the journey of running any business, really. But the key part is to be able to, I think the best founders are the ones who are able to kind of have that process, I guess, of getting those inputs and then getting those inputs from people that hopefully have some idea of what they're talking about, and then synthesizing that into going, okay, well, of the 5 people I spoke to, all of them said the same thing. Maybe I should just do that. If you speak to 5 people and they all give you different answers, or they all say, no one knows, everyone just makes shit up, then you go, oh, okay, I'll make some shit up and I'll see what that looks like. But you want to have a sort of founding approach of where you go, okay, well, let me take these information inputs and then synthesize into what I think the actual answer might look like.
Oh, solo founders, Hugh. You're the only founder, and then now sitting in your investor seat. What's your view on this? Because this can be a bit scandalous sometimes.
So VCs hate solo founders, full stop. And I am a solo founder, right? So it's very, very hypocritical of me to say. But at the same time, I've also seen what it's like as a solo founder in the journey. And there's so many challenges and problems that you generate being a solo founder that you just don't have as a team. Yes, you have the risk of a team having a breakup. But with a solo founder, for example, if you have a mental breakdown, which you probably will at some point during your startup founding journey, let me tell you now, I've had at least one, if not multiple. The problem when you're a solo founder is there's no one else to pick up the slack. In a co-founding team, at least the team can help, kind of pick up some of that slack. Or if the business is sort of at the late stage enough that you have senior executives that are able to do that, then it can kind of limp along while you sort of get your mind together again. But it's very challenging and very risky, and it's very lonely. Even when I now have a very senior executive team, all that kind of stuff, there are a whole lot of things where you simply can't talk to the team about these challenges. And it can be very hard to have those conversations, whereas between co-founders, you're able to do that. And then finally, like when it comes to software companies or companies that involve a lot of software, it's really hard to be someone who has good software engineering development skill and also good sales and marketing skill. I would describe myself as a absolutely rubbish software engineer, like terrible, but I can kind of cobble it together enough to put an MVP together. And so I've been able to kind of just scrape through, but that's somewhat rare. And you definitely can't do it when it's like, I have no knowledge of sales and marketing and I'm just going to hire that, or I have no knowledge of software development, I'm just going to hire for that. It's a really, really, really hard journey, because when, again, 2 a.m. happens and like suddenly the servers are down and the database is shitting itself, you don't want to be going, oh, I better call my employee. You want to be going, oh, I'm going to get my co-founder out of bed right now.
That's a good one. We have a question about our solo founders. What made us invest in them?
Sometimes you make exceptions to the rules. Is the simple answer. I think one of the things to think about is in venture capital, everything is effectively negotiable, right? And we talk about what is typical, and there's always exceptions to everything. But what happens is that when you're an exception in one area, you need to be exceptional in another, right? So if you're a solo founder, I go, oh, and what that does is that raises the bar in every other category, because then I have to go, oh, okay, so what's going to offset this risk of being a solo founder? Or, whatever, you can say the same thing of, varying degrees of traction and all that kind of stuff. It's like, so one of the things that helps solve that for us is to go, oh, well, despite being a solo founder, this person's generated a huge amount of traction. We can't really explain why. So like the product is amazingly seems to have struck a chord with its audience in a way that I wouldn't have expected. And maybe that does, sort of like bring down this risk of a solo founder. And you talk to the founder and you say to the founder, hey, so let's go and hire you essentially co-founders. And that sort of becomes part of the hiring plan as you actually sort of execute on the investment coming out the other side. But, like everything else in VC land, it is negotiable, but it's always that sort of give and get kind of balancing act of where, when you are the kind of company that's got challenges in one area, maybe it's early, it was pre-launch, maybe, I don't know, the product isn't there yet, whatever it is, it kind of has to be made up somewhere else. And so you've got to sort of realize that that's how we sort of, yes, things are always a package deal, but whenever things look weird, we have to then go, okay, well, this is the thing that makes it good, even though it's weird in this other area.
Yeah. Another scandalous view, app agencies with no CTO. Why does this make VCs cringe?
Yeah, so I've learned as an angel and also generally speaking in the startup industry, there are pretty much zero companies that get to scale that were started with the founder paying an app agency to build them. Pretty much zero. And at best, the app agency, outsourced development company, whatever it is, at best they can point to a couple of examples where they might have raised some money, but they all die. Or alternatively, like I'll say, the exception is if you're building a business that's you're an e-commerce company, right? And like it's a new shampoo that you're selling or something. Yeah, okay. Like you may not need a big tech team in house because you know what, you're just going to use Shopify and that's going to be your e-commerce and that's essentially your tech stack. And I'll go, yeah, sure, I think. But in any situation where technology is a core part of the business, you need to have those skills in house, and that's because when stuff goes wrong, you don't have to call the agency. When stuff goes well, you then have to try and poach people out of the agency. You never learn actually how to properly manage a software development team as a founder, which then means that even if you are successful at getting to scale, you then have to relearn all of that at a much later stage when you should be learning a whole lot of other stuff. It costs more because you're paying someone else's profit margins. Like it's all of these things. And really as a VC, it often shows that you as a founder actually can't recruit the engineering people necessary to like believe the dream and get the work done. And so there's also kind of this negative signal saying, well, okay, like if you're willing to outsource this piece of the business that is like the most important piece of the business, what else is going to be outsourced that is really, really vitally important? That's not saying you should start on day zero with an in-house accountant full-time, like just pay an accounting firm. But when it comes to things that are the core competencies of the business, and in software, that's software engineering, they need to be in-house. And that's where it's like, realistically for us, most of the time, it should be that if you just took the co-founding team alone, they should be able to essentially run the whole business. And it might go more slowly and all stuff, but like in that ideal capacity, and that's where typically in a two co-founder situation, you've got one person that's more sort of sales, marketing, operations, one person that's more, technology, software engineering, or whatever, in a typical two co-founder software company kind of situation. The reason why we have that balance is because then effectively between the two of them, they can run all the functions of the business. And if suddenly you lose all of your senior talent, and I've seen this happen, like suddenly all the software engineers leave, you've got to have someone left over who can do it. And that's, again, where that co-founder piece comes in and becomes very important.
Yeah, it's a tough one, the CTOs. Market and vision.
For every non-technical founder looking for a technical founder, there are technical founders looking for non-technical founders. So it's actually often much more about that matchmaking piece. And realizing that, for example, a co-founding relationship is very rarely started with, hey, I have this idea, will you come and do the idea for me? It's much more around, hey, I want to go and solve this problem. Will you work with me to solve this problem? Do you care about this problem enough to solve it with me? The bad situations are when founders think they can just sort of like have some 400-page business plan. We don't care about business plans, never write a business plan for a VC. But they have some sort of 400-page business plan for the next 15 years, and all they need is people to execute, and you're like, you're going to have a hard time.
I think that's a good point. Don't get a CTO purely to execute. He's your business partner, he or she is. And so that's a partnership.
All of your early employees are essentially business partners.
Yeah.
Strategy is distributed at the early days.
Cool. So market and vision. When looking at a market sizing slide, Hugh, what are you looking for? So this one's always a tricky one as well.
Yeah. Really, I think it doesn't really matter how you come up with the answers. So what I want to be able to do is I want to understand the assumptions that you've made to come up with the answers of the market size that you've got, right? So when you're, like pulling numbers out of a bag, I want to sort of know where the bag comes from. no one ever has any real idea as to what market size looks like, and particularly early on, but even often late on. You know, like if you look at the early days of Uber, you know, they were going to be a small taxi alternative company, and then they end up obviously growing substantially bigger. And you know, so what we're really looking at is like, part one is what's kind of the assumptions that sit underneath this. Is this just kind of like prayer, or is this like some kind of indication of going, okay, well, we think our serviceable market is this big because of this. It's not just kind of like, oh, if we just got 1%, because I'm like, well, I don't know if you're going to get 1%. I don't know if you're going to get 10%. I don't know if you're going to get 0.5%. Like, you know, all of those numbers are just made up. What we do want to make sure, though, the second piece of that is to say that the market needs to be the sort of thing where if the business does well and you can execute and things go to plan, it's big. And that kind of comes back to that question of like sort of the scale side of the business, because when we sort of, you want to be able to, as a VC, you want as an investor, you want to be able to squint at it and go, okay, well, if everything goes really, really well, does this get really big? You know, does this become, you know, hundreds of millions of dollars of revenue or whatever it might be? But we want to make sure that gets there, because one of the easiest ways to be able to grow a big business is by being even a small or medium-sized player in a giant market. Sometimes you go the other way and you say, well, actually, the market's really small right now, but it's going to be really big. And I'm like, oh, okay, it's a different thing. But that's quite different. You know, there's sort of different ways to try and slice it up. But it's still, you're aiming to answer that question of like, when I squint at it and I think to myself, if everything goes well, does this get really big? And do the founders want this to get really big?
And what does that mean for, say, VCs and what kind of return they want to see out of that market?
Yeah, so I guess the nature of how our funds work, so the math of how a VC fund works, is that of a typical VC fund in its portfolio will have typically 15 to 25 companies in each fund. And of those 15 to 25, we have higher because we're an earlier stage fund. So you kind of, as you get it earlier, you can have more hits at the bat. But of those 15 to 25, probably 50 to 70% will die. They'll write off all the money, and that's expected. Then there'll be a handful that'll return, roughly speaking, cash on cash, right? So if I gave you $1 million, you'll give me back $1 million, right? And that's kind of useless for me. It might be a great outcome for a founder and all kind of stuff, but like as a VC, those funds don't really help you very much, because obviously you've got this 70% or 50 to 70% that are dead, right? So 1x cash on cash doesn't solve for my dead portion. Then you have a handful that'll give you, 2, 3, 4 times the amount of money in. So if I gave you $1 million, you might give me 4 or 5 back, and they're good, and they can help offset the rest. But again, you're still not really getting there. And then you end up typically with between 1 to 5, right? Usually it ends up being 1 or 2, but let's give it up to 5 that'll return like 100 or 1,000 or whatever it is. So it's like I've given you $1 million and you've given me back 150 million or 200 million, and they're typically the ones that end up actually returning all the money to the investors of the fund. And that sort of is that, again, it's that whole piece in finance of risk and reward, is that we live in this very, very pointy high risk end of the world, where if everything goes really well, it's a huge business for everyone. But the most probable answer is the business will fail. And that's our expectation. It's the expectation of our investors of the amount of risk that we need to be taking as investors. And so as a result, when we talk about a big vision, it's like it needs to be the sort of thing where it's like, hey, like if I squinted at this and I fast forwarded 15 years and everything's gone amazing and everything's happened the way you think it's going to go, or whatever it is, like this will return, $100 million or $200 million on my $1 million investment. Or half. It's not unbelievable. This seems incredibly strange, but it's not unbelievable at all for a VC fund in the global sense. Obviously, it's only the very top little bit of VC funds in terms of performance, but it's not unbelievable that a company that they might have put 10 million into returns like 1.5 billion. It's not that's not totally out of reality. Obviously, it's only very rare circumstances, but that's essentially is what you end up looking for.
Pretty helpful knowledge to consider when you're doing your market sizing. And then moving on to traction. What do you get excited about, Hugh, when you're looking at traction? Because this one's always a tricky one. I mean, all of this is tricky, but this one in particular, because we have a lot of conversations with founders about it.
We like to see some, non-zero. And I guess for me, traction lives on this spectrum of like, you know, on one end you have like, hey, I've got email addresses of people. And on the other end, I have like paying customers for my product who are paying full price for the product. And so, you know, like you can sit anywhere within that spectrum, right? And so really, I guess for me is it's just like, what I want to see is I want to see that that people are using this, right? So it's actually, if, you know, it's generating sales or it's generating users, you know, maybe that they're just free users. It depends on the business model of the business, right? But like it's actually generating users because, as I mentioned earlier, like as soon as a product hits customers, you start getting so much more feedback about what's wrong and what's right that just like you realize that all of your assumptions that you've made previously are just totally wrong. And that happens to everyone. So and that's fine. So you expect that. But not having those customers and not having enough of those customers to be able to get that insight then means that you're building things in the dark. And so a big red flag for us is actually the sort of founders who will say, oh, no, I've got to keep building this for another 9 months before I can launch it. And I go, whoa. You know, like that might be true if you're building a new ERP for, you know, that's going to replace SAP in giant enterprises in the Fortune 100, but like you're probably not building a giant ERP that's going to replace SAP. Or if you are, then, you know, you're probably going to be a very different kind of looking founder than what we'll typically engage with. And so as a result, it's like, you know, the traction that we want is we want to see those. And I'd rather have, so in terms of the balance, for me personally, I'd rather have a smaller number of users that are deeply passionate. Like I'd rather have that niche and that very clearly defined group of early customers who all say to you, holy shit, I love this product so much. If you took it away from me, you would ruin my life, right? I want to see like those type of customers are amazing because you get so much better feedback from them. You work with who they are. And I'd much rather that than like have, I don't know, 50,000 customers who don't give a damn about the product. So, you know, like fewer customers early on, but customers that are very, very engaged with you and very engaged with the product is actually a much better signal than a lot of customers that are just totally disengaged. And that's why, like, I don't really care about the email newsletter people, or I don't care how many Instagram followers you have or whatever it is, because it's like they're disengaged people. And there's no indication to me that they're actually going to buy, that they're going to care, or whatever it is. If it's their email newsletter people who've spent 45 minutes, you know, filling in a 200 question survey, oh yeah, okay, that, you know, they've gone to a degree of effort, right? But just purely they've followed me on Instagram, or they've put their email address in the box on the website, pretty meaningless.
Not substantial enough. And then, oh, sorry guys, we also have a blog called What Investors Mean When We Say Too Early. So there's a bit more on traction there too, if you'd like to jump on there.
So yeah, and on that, I guess investors typically don't like saying no. And the reason investors don't like saying no is because you want to always be able to have, you maximize optionality, right? So we want to make sure that as investors, we always have the option to invest at some point in time, which is why a lot of investors will give you kind of like a you're too early or a slow no or something like that, is because really they're effectively saying that there's not enough, you know, sort of traction or metrics that make me confident writing a check. But they don't want to just say no because they want you to make sure that you'll come back to them, or, you know, if the metrics change and they can go, oh, suddenly I want to write a check, right? So we try and, as Galileo, we try and actually at least say to you no, or we try and say to you no, not now, as much as we can. We try and tell you the, you know, internal reasons why. But that's why a lot of founders find it very frustrating, is because investors won't, when investors say there's not enough traction, what that really means is no. And it generally means no until sometime in the future where something's changed. And that's, so it's kind of it's really, for the purposes of you've got 3 months to raise money, it's a no.
And then speaking of Instagram before, go-to-market strategy. Controversial views on whether Facebook and Instagram are part of a solid strategy.
Look, I go backwards and forwards on this a lot. And I think Luddy's probably seen me go backwards and forwards on this a lot. There's a certain kind of business and a certain kind of founder that suits a highly ad-driven acquisition strategy. And generally speaking, they're the type of founder that lives in effectively the world of hedge fund style arbitrage, because doing Facebook or Instagram ads at scale is essentially the same as running an arbitrage campaign of, in the public markets. And if you talk to someone who's done a lot of media buying and stuff like that in the past, particularly online, they'll be able to tell you, like the best people in this space will be able to tell you immediately, oh, like what's the cost per 1,000 impressions on Pornhub right now? And do they produce, what's the average conversion rate through Pornhub compared to Google's display advertising via the news segment as compared to Google's display advertising via the entertainment segment as compared to, what's the CPM of a YouTube ad at the moment? Like they'll be able to tell you all of those numbers, and they'll be able to tell you how they've changed over the last month or even the last week, because it is purely financial arbitrage. So in that situation of where the business supports that, and that's where you've seen a lot of those like e-commerce type direct to consumer brands grow, is because it's actually in some ways quite easy, where you go, okay, well, I put $1 into Facebook ads and I get $3 of sales back. And you're like, and it's quite direct, and there's a lot of reporting and there's a lot of structure of how you do that, but it is kind of ultimately an arbitrage business. So in that case, I'm like, great. In almost every other case, I'm like, it's a bad way to reach customers. Customers in that space are generally, they're doing something else. They're not explicitly looking for your type of solution or your type of tool, whatever it is. And it's an expensive strategy to run early on when you, typically speaking, don't have enough money. So I always go to, what are the free/cheap low-hanging fruits, or the things that essentially just cost you in person time rather than in dollars per impression, and saturate those channels first before you go and hit advertising really hard, because you want to be able to, the best advertising speaks to the customer, and so to do that you need that customer insight. And so you don't want to use the advertising to discover the customer insight. You want to know the customer insight and then drive and build and define the advertising around what that actual customer insight looks like, such that when those people do see the ad, they go, oh wow, that's me, and they click on it.
I might move on to the next one because we're running out of time. Valuations. What are your thoughts on this, and how should founders approach it with Australian VCs in mind? Yeah,
so the simple rule of thumb is that pretty much every time you raise money with for a sort of a startup, right? So venture scale type company, every time you raise money for that type of company, you dilute the existing shareholders, which for us is typically just founders at that point in time. So we will often be the first investor. The dilution is somewhere between 10 and 20%, and probably averages 15. So if you do 15 plus or minus 5. So really, the way I would think about valuations at the early stage is not what other people get valued at or whatever. It's purely how much money can you raise, and that's a driver of how much money you need. Like I said, if I just suddenly gave you $10 million, you wouldn't be able to spend it in a year, right? Because how much money do you need in like 18 months, 12 to 18 months? So it's how much money do you need to raise? How much money can you raise? Not everyone, people aren't just going to give you 10 million when you have, when you have no actual product. And then that ends up being somewhere between 10 to 20% in dilution. And so that effectively gives you a valuation range to work and assume and sort of, work under the assumption of. And we on the other side of the table will again, operate on that rule of thumb basis. And so exceptions to that do occur, but same thing, the hurdles go up when the exceptions occur. So if it's a thing that's like, holy shit, the traction of this business is just like off the charts crazy, it's wild, whatever it is, yeah, you may end up actually raising and only diluting the company 5 or 7 or 8% or something like that instead of 10 or 12 or 15. But that sort of is made up for it by that traction piece that's different. And so where you see some of those, when you look at that question the US investors people asked earlier, is like, part of the reason that valuation is driven up is because the round size is bigger, right? So, and part of the reason the round size is bigger is because the cost of people is bigger there. The cost of an engineer in San Francisco probably starts at about $250,000 US, maybe 300. You might get a junior for 150 or 180 US, right? So that's like, effectively 240 Aussie. And so obviously as a result, you need more money because you've got to pay more money for the people that do the work to build the company. And so that is sort of where those levers end up. But you'll still find that at that pre-seed and seed stage, the companies are still ending up the dilution of that typically will still end up being somewhere between 10 and 20%. And at the later stage, it may actually have a lower dilution. So when you get to like Series A, Series B, Series C, so when you're raising, some 5 to 50 million, there are all of these other terms that come into play that investors will put in where, okay, you might let the valuation, like maybe it's a Series C or D and you want to get $1 billion valuation, and that's obviously very exciting, and you can announce you're a unicorn and it's amazing, whatever it is. But what will happen is that actually the investors will go, yeah, okay, we're going to put in 100 million at $1 billion valuation. But if you exit at less than $1 billion, you're going to return 2 times our cash back first, and then everything else. There's all of these other things like liquidation preferences and ratchets and stuff like that to be able to give investors downside protection that allows founders to negotiate valuations up. But essentially, if they don't end up continuing to be stratospheric, it stuffs over the founders. So the founders end up with less money, in any kind of exit scenario. So that's where you sort of see those balances come up at a later stage. At an earlier stage, no one's going to have ratchets and liquidation preferences and all that kind of stuff in early stage deals, or if they are, you don't want them as an investor. And so as a result, you end up with that 10 to 20% range, where anytime you're out of it, people will go, oh, better justify that.
Mm-hmm. Great answer. I think we might wrap it up. We're almost out of time.
Any questions you want me to ask, Luddy? Or questions you want me to answer?
I think we've got 2 minutes left, unless you've got extra time.
I've got an extra 5, I think, because my board meeting cancelled.
Great.
Let's use 5 minutes for final thoughts from Hugh and Luddy. And thanks so much for your time today. I know I've got a lot out of it. I know our audience will have. I'll also just mention that the recording will just be distributed to this audience along with a thank you email. So any key messages we can distribute on your behalf too. So thank you for the time. But any last thoughts to wrap it up?
So my last thought's going to answer the first 2 questions in the Slido. So I think the last thing that we probably haven't talked about is that question of industry thesis. So some funds, so every fund has a thesis. They have effectively a mandate of what it is that they invest in. Some funds will focus on particular industries. So some funds will say, hey, we want to do, biotechnology, or we want to do therapeutics, or they want to do software as a service sold to enterprises, or whatever it is. So some funds will have a very explicit mandate. Other funds will say, hey, this is the kind of stuff that I like. And often that's driven by what the fund managers are experiencing or what they think is going to be very successful. Other funds will go on sort of a bottoms up thesis driven. So some funds will go, hey, blockchain's really big. Let's go and find a good blockchain investment. For Galileo, we essentially take what comes. So we don't necessarily have particular markets that we focus on or we're exclusive to or anything like that. And, we'll look at hardware. We have looked at hardware. We've looked at biotech. We've looked at tons of software, in anything imaginable. But we don't have any sort of rigid guidelines. There's a couple of regulatory restrictions, but they're kind of different. And so, and that sort of is that combination of the sweet spot of, what we think is going to get big, because you don't really want to be investing in a space that's getting smaller, because that's going to probably not produce a really big outcome. But other than that, we're pretty broad. So I think in terms of my other summary sort of views and thoughts and things, is this is an industry where you're rewarded from engaging early, and you should absolutely think about engaging early and sort of talking to investors and stuff like that, because we're very happy to talk. Very happy to talk to you and say to you this is too early. And one of the things that you can do best as a founder is to show us that you can execute. So you can talk to us and say, hey, I want to do X, Y, Z. And then when you send us those monthly investor email updates, we read them, because of course that's our job, is to read those investor updates. But when you send them through to us, we also notice to see when you go, oh, okay, so 2 months ago they said we're going to get our MVP out in January. Now it's January. Are they saying, oh yeah, we've got our MVP out, right? And you go, oh, okay, this team can actually execute on what they're saying they're going to execute on. The companies that you don't invest in, I guess, are the ones where in January they go, oh yeah, the timeline's blown out until April. And you go, maybe that's for a good reason. Maybe it's, it's obviously context specific. But being able to kind of build that relationship over time is a very useful way to be able to help us actually do that. And to answer Alex's question, yeah, climate tech's included. We don't do explicit impact investing, so it still has to meet the barrier of being able to produce a return for our investors. But absolutely, all VCs will tell you that we think that climate and impact investment type areas can still produce venture scale returns. Luddy, your thoughts?
Additionally, on what's hot in the VC industry and what we're looking for, the best way to find out is jump on Twitter and follow all the VCs because they'll likely share with you what their thing is. Easiest way, or their blog posts as well.
Yeah. It's not always obvious, and people's thesis changes over time, and that can be like, even for me when I'm referring deals to other VCs, I'll often have to be like, hey, like, is this actually in thesis? Like, do you believe in this industry or not? And sometimes they'll say yes at one point and no at others. And so, you do see that changing over time, which is where it's kind of like with the kiss many frogs problem. But Luddy's right. Like, generally speaking, we are all quite active on Twitter, and we'll generally give our fairly unfiltered views on those things.
Lots of unfiltered views. To finish up, if you have a question I didn't answer, I'm going to pop my LinkedIn profile in here, so you can always message me anytime. And in addition, our applications are still open for funding, so apply.galileo.ventures.
It's a very exciting microservice. I built it myself. Like, you get the joy of seeing some code written by the actual founder of a VC firm, which is pretty rare in Australian VC, at least, not so much. So
wonderful. Thanks so much, Lloyd. Yeah.
Incredible. Thanks, Luddy, and thanks, Hugh, for your time. I know I look forward to hearing from you again and continuing to engage in this space. So I know you've helped out a bunch of other Monash founders before, and look forward to sending a few more teams through to Galileo. So I should also call out our showcase is November 24. Everyone will be invited to that and to hear what we're doing at the moment. So again, thank you for your time. Enjoy your afternoons.
Awesome. Thanks all.
Everyone.